Hello and good evening. Welcome to our sixth session on the F6 Live. Tonight's session concentrates mainly on capital gains tax, and we will be looking at shares. So welcome to our session number 6 on for F6, which is taxation. And as per the study planner, tonight's plan is to look at capital gains tax, primarily looking at shares. Now, when you look at capital gains tax, last week I did some variations with capital gains tax with you. Now, when it comes to capital gains tax, there are a few things that we need to be looking at, and the reason we need to specifically learn about the rules relating to shares, because there are certain specific things on shares that can change how we calculate our gains. Now, last week when we're looking at the variations for capital gains tax, one of the variations we can have is when we have a disposal. Oops, that's too big. Okay, when we have a disposal of an asset at less than market value. When you have a disposal of an asset which is less than market value, whether this is a sale or even if the asset is given away for free, this is often known as a gift of an asset, because a sale at an undervalue also stands for a gift, because when something is sold at less than its market value, even if the buyer does pay something for it, the fact that it is less than market value constitutes that there is an element of gift. So for instance, if I look at a normal asset, maybe a building, okay? Imagine you've got a dad, a father, okay, and you've got a son, okay, and dad gives a gift of an asset, gift of asset to son. The market value of this asset, for instance, is say 150,000. Okay, and let's imagine that the dad bought this asset for 100,000. What happens here is that when you have an asset which is being given as a gift or which is being sold at less than market value, what happens is that this is known as a deemed disposal at market value. Okay, this is regarded as a deemed disposal at market value. So if you look at dad is treated as if dad has sold the asset at market value. Okay, even if, for instance, the son pays some cash, let's say the son pays 110,000. 110,000 is less than the market value. Okay, so what you find over here, dad is treated as if he sold the asset at the market value. So dad will have what we call a deemed sales proceeds, and the deemed sales proceeds will be the market value of the asset when gifted. Okay, and the son, on the other hand, is going to have a deemed acquisition cost, which is also the market value of the asset when it is gifted to the son. So if you think about it, what happens to dad is that dad will have a deemed sales proceeds, which is the 150,000 less cost of 100,000. So dad will have a gain of 50,000. So what's going to happen is that dad is going to pay tax on this gift that dad has given. Now, of course, yes, there would be some relief. We will talk about the gift relief when we get to reliefs next week, as that's the plan for next week. But I want to come back to one thing over here, is that when there's a disposal of an asset at less than market value, a gift is an example of that. This is known as a deemed disposal at market value. So when you look at any other asset, for instance, if you look at a building, the market value is quite straightforward in the sense that, you know, the market value will be the same. There'll be one market value on the day that the asset is being gifted. But if this asset was shares, then there's a problem attached over here, because we need to identify the market value of the shares. So one of the things that we need to think about with shares the first issue we have with shares is when there is a gift of shares. Okay? When there is a gift of shares, the reason I say this is going to be the issue that we are faced with is because when there is a gift of an asset, it's deemed disposal at market value. So in other words, we need to identify the market value. The identification of the market value is done by using two methods, and we will use the lower of the two methods. The first method is known as the quarter up method. The quarter up method is used when you have been given the lowest price and the highest price for the day. So the quarter up method takes the lower price of the day, okay, plus quarter of the difference between the higher price minus the lower price. So that is your quarter up method. The second method is known as the average bargain method. The average bargain method is used when we have been given different bargains of the day. The shares will have been bargained at different rates during the day. So here we are going to take the highest bargain plus the lowest bargain divide by 2. And remember that the market value is the lower of the two.